Hi, everyone, and welcome to PerformLine's webinar. My name is John Zanzarella. I am the SVP of Sales at PerformLine, and I'm really excited to be here today with you all, be with our guest speakers, and talk about all things CFPB. We're going to cover things like complaints, enforcement, the surge in rulemaking, and look into our crystal ball to make some predictions for the future. And we really have the best guests to help us do that. Both CFPB alumni, both doing really exciting things today. I'm going to pass it off to them for the introductions. Melissa, why don't you start?
Thanks, John. My name is Melissa Baal-Guidarizi. I'm a partner in the DC office for Orrick, Harrington, and Sutcliffe. I advise fintech and traditional financial services clients, help them navigate the friction between innovation and compliance in this digital age. I am lucky enough to have served at the CFPB for 8 years with Gary Stein, who is my co-panelist today. And prior to that, I was in-house for Citigroup businesses that were state and federally regulated. Happy to be here and glad to be invited by PerformLine.
Yeah, great to have you, Melissa. Gary, we know you're a repeat guest, but you were able to connect us with Melissa, and we're thrilled to have met you and have you on here today.
Yeah, thanks for having me back. I guess I passed the test. I'm a partner with 99 FinTech. We are what we call us a contingent advisory firm. We work with banks, fintechs, processors, merchants, anyone in the payments, lending, and banking ecosystem to help them through transformational events. And we'll put skin in the game, put our fees at risk and to ensure that our success is tied to their success. As John and Melissa indicated, I spent about 9 years at the Bureau on the policymaking side, working on issues primarily around deposits, overdraft, payments, unsecured lending, and consumer data and data aggregation. A lot of focus on the emerging market side. And then for about 20 years prior to that, I was a banker and bank consultant, really in the blocking, tackling side of banking, deposits, lending, consumer commercial, when banking was, even when it was a little branch driven. So I've seen the whole transformation here, but great to be back.
Yeah, good to have you, and it's awesome that you get to bring that history to your clients at 99 FinTech. And
Nice
I know
way
you
of saying I'm old. Yeah, thanks.
Yeah, doing wise wisdom, right? So we'll jump right into it. At PerformLine, for anyone who follows our content, we are big on following consumer complaints. One of the most notable trends that we've seen here with our different reports at PerformLine is just the increase in complaint volume. Some of the numbers even surprised me. Consumers submitted about 500,000 complaints in 2021. That number increased to 800,000 last year and is already over 1 million in 2023. Of those numbers, the last 2 years makes up about 43% of all complaints received by the CFPB since it established the Bureau in 2011. Curious to hear from you all, what do you make of this trend in the increase of consumer complaints, and what does it mean for the consumer finance companies who are trying to track those complaints?
So I'm happy to jump in first. I think first, all the data geeks on this webinar and maybe amongst ourselves would probably want to normalize some of those numbers and make sure the complaint increases aren't because there's more companies onboarded to the portal or topics and other things like that. I think it's hard to disentangle anything over the last few years from the pandemic and what's happened since then. When the period of 2021, we were still coming off stimulus payments and things like that, and maybe inflation was just starting to make us grouchy, maybe not as grouchy as it has been. And so there's those macro events. I think there's also things that you can observe in the use of consumer financial services products like credit cards. We see, reportedly revolving line utilization increasing and delinquencies. And I think for consumers, especially subprime borrowers, access to credit and things maybe getting more challenging and being able to pay those off. So that could lead to more disputes and frustration with those disputes. Same thing on payments. All the major P2P and emerging payment providers are growing at about a clip of around 10% a quarter. So you have a greater volume that even when most of the time things go well, still creates more opportunities for things to go poorly. And on the credit side, especially because the majority of complaints always tends to hover around the credit bureaus. If people's credit isn't what they need to get them access to purchases or just day-to-day living, it's probably going to generate some volume.
So I'm going to just riff off of what Gary said with a couple of points. So I'm a lawyer. Gary is not, although he plays this one very well usually. And I was in the Office of Enforcement for all 8 years. I was at the CFPB, and we use complaints really regularly. So what I'll, validate on, like, I totally agree with Gary on the consumer experience. During COVID and pandemic times, there were stimulus payments. There was a increase in digitization and payments that were online. Some of the downside effects, you didn't see that much in the complaints at the time, but now we're coming out of that time with more debt. Wages are flat. The economy is in a state where you'll see more of those complaints. And so the fact that fraud has gone up in this market, in these markets, has been really difficult on some consumers, and so complaints have gone up. Second point is really, this is showing that the CFPB has succeeded to some extent. It's only 12 years old. It started out as a startup federal agency where sometimes I would call another federal agency and they didn't know who we were. And now the CFPB has succeeded in brand recognition and letting people know more about what their rights are and where you can complain. So, since I'm more qualitative than quantitative, I'm not going to try to do any of the statistical stuff, but some of this may be just the fact that the system has more participants because there's more knowledge about it. But what I really think it should matter to all people in this ecosystem is that there's more out there. There is more data out there in general. So state and federal regulators, plaintiffs' attorneys, they're using the consumer complaint database to sort of mine what they should focus on. And so companies should be doing the same. It's the same data set. You can use it too. And it's a good way to help figure out how to have a continuous improvement cycle for your products and services.
Yeah, I think when we first spoke, Melissa, that was one of the things that really stood out that you mentioned. Just, we talk about at Performline, we see a lot of our clients using consumer complaints as an early warning system for potential regulatory action. I do think it's one thing to be aware of the complaints. It's another thing to be organized as an organization to understand, how do we bucket complaints? How do we respond to these complaints? What are we required to do from a regulatory standpoint versus what do we want to do from a brand and a proactive standpoint? Both of you had the opportunity to work in-house at companies, to support companies as external advisors. How are you coaching your clients today on how to use these complaint information for their own internal processes?
You want to go first?
Yeah, so I think trend analysis is important. Trying to figure out what types of products and services are hitting the highest. Because if you're going to have an exam, or if there's a product or service that's hitting higher on the consumer complaint database, you might get a CID. You might be the target of an investigation. And so you need to know what those things are yourself. It's also a good way to trend, how is your staff, how are your systems dealing with customer service? Customer service is continuing to be an increasing focus for all regulators, particularly the CFPB, and how quickly and how well you answer your own customers can really help you mitigate risks and actually improve your uptick and your portfolio, your market share.
Yeah, I agree. If you're not really attuned to this information, you're putting on blinders that forget about regulatory risk and consumer harm. You're just doing a disservice to your business and your revenue potential. It's interesting because the clients we work with, I can think of several instances in which we get into this subject and there's a debate about what's the definition of a complaint, and I think, from a regulatory obligation standpoint, it's good to have a pretty tight definition. But from an internal management, I think keeping a broad scope is bright. Consumers may call in a non-angry manner and express, very politely confusion about an offering or a service or what they're due or how things are supposed to work. And those are really important smoke detectors, because for everybody that's calling in, there's got to be dozens, if not more, that are inhibiting that. Some of those will be, quiet atriters, and some of those are maybe talking to plaintiff attorneys and all kinds of other things. And so having that focus on that experience and what they're saying, I think is important. And, so there's the whole, let's have a game plan for resolving these things and reporting them and all those things. But really, the goal isn't to use this information to show a regulator that we care. It's to walk the walk.
Yeah, no, we see that, we have clients who use tools like call monitoring. Well, they want to monitor 100% of their calls and then separate out the ones that have some sort of consumer complaint. But you can always tell they're not doing that because of a regulatory requirement. A lot of times they're doing that because that's in their business DNA, where they really want to hear the voice of the consumer and then be able to respond to that. And so, while we agree that the complaint database is this great early warning system, another notable trend from the CFPB is that the number of public enforcement actions has actually decreased in recent years. Now, consumer relief increased significantly. The CFPB is talking about plans to hire more enforcement attorneys and support staff. But what do you expect? Do you think the number of enforcement is going to go up? And what do you attribute maybe the decrease over the last few years of enforcements to? And Melissa, maybe you can start with that one.
Sure. So, part of this is just natural progression, perhaps because I was in the Office of Enforcement my whole time. The CFPB is growing and its jurisdiction continues to grow. And so you need more staff. But this director has made it very clear that his focus is on big tech, big. So, the focus is on larger market moving type matters, instead of focusing on trying to get a wider swath necessarily of smaller matters. And that's borne out in the cases that you see. The other thing I would say is the CFPB as a maturing agency is getting more pushback. So not only because the Supreme Court is still figuring out constitutionality, but also because the demands are getting higher and companies are becoming more willing to fight back. There's more litigation. So you need more lawyers. Litigation is a different kind of animal than just settling matters. So that is a natural progression, which people should have, could have predicted in the beginning, because in the beginning, there was a lot of consent orders and now there's a lot more litigation. But finally, my big thing that I've seen since I left is the idea that enforcement goes beyond the Office of Enforcement. This administration has really tried to maximize each tool that Dodd-Frank gave it, to the point where, we're going to talk a little bit of maybe the larger participant rule that just recently came out. But from the very beginning, the CFPB has said supervision is going to expand over non-banks. We can call out a non-bank, any market, any size that we think has some consumer negative impacts, and go through a process. There's more rules being put out to gather more jurisdiction, both for supervision and enforcement. The supervision highlights are actually much more detailed. There are FAQs that go out, advisory opinions at a much higher clip. And then there's always the bully pulpit, which has been revived pretty powerfully by this director, which is just making statements, lots of speeches, lots of blogs, where Director Chopra is very clear on what his goals are and what he thinks should be happening. And so I think enforcement writ large is something to think about more than just sort of the traditional how many cases are out there. It's easier to just focus on those.
Yeah, I think you mentioned something that's really important. If you are a chief compliance officer at a bank and you're looking at the enforcement actions being down, that doesn't mean that it's time to sort of take your foot off the pedal and that's not going to come. what you're saying is that the enforcement power as a whole is actually increased, and we're seeing that through some of the supervision and different rules that are being announced, and things that are outside of the CFPB purview traditionally that now are making their way into the fold. Is that accurate, Melissa?
Yes, and Gary's old team has a lot more powers and a lot more staff as well. I mean, happy to pitch to him on that, because there's a lot more going on in that side of the house. When we worked together, it was a little less active, and perhaps in the way it is now.
Yeah, that's true. I think there's been staffing up in a number of areas. And part of it, it's also is interesting in the staffing up is that, again, as Melissa said, the agency's only 12 years old. So you've had, some people, like I was originally supposed to be a term employee and converted and stayed a few years longer than I ever thought I would. And then you have folks in there. I think there's always an interest, especially in a fast evolving market, to bring in new folks with new understandings. I would just add that I think we've now, got 2 data points with 2 administration changes. And in both cases, there was a kind of a dip early on as they kind of maybe reassessed what was in the pipeline under the prior administration, and then kind of refocused resources accordingly to maybe what they saw as their policy agenda. So I think that dip and then expansion out may be in some part related to that. What's interesting is that I think every director at the Bureau, regardless of what side of the aisle they come from, has recognized the value in the measurability of enforcement actions. And you talked about the dollars, John. I mean, a rulemaking, quantifying its impact. I mean, they have a lot of economists that can do that, but it's a little less direct versus an enforcement action. We can count off the billions of dollars that have been returned to consumers. And I think many directors have made sure that shows up at the bottom of every press release and everything they put out. It is a way to measure their legacy. And I think all the directors, whether they go in with the attitude that we're going to lean on enforcement, they recognize that over time as it's a great measuring stick. Yeah. And then the last thing I just say is that, Melissa's job was a lot easier than mine. They would look at very specific facts and circumstances. It's only with one company. It'd be a little easier than writing a broad rule that had to apply to the entire market. But all jokes aside, I think there has to be this big picture perspective held within the Bureau, because the other thing that can happen is where there are policy making agendas and you come across a player in the marketplace that maybe whose actions need to be curtailed, there is consideration given to how would this case implicate or change for the rule that we're going out to the broader market, and how would that happen? And I think it's kind of interesting as the Bureau starts to put out more rules now. One might think that in the immediate aftermath of a rule implementation, we might see more enforcement actions as companies aren't yet compliant with those new obligations. But over time, the rules should, convert the Wild West over to a more orderly and consumer-friendly market. And we should see, at least in those areas, enforcement actions decline. I don't know that we have enough data, though, to prove that out.
Yeah, you bring up an interesting point, though, Gary. So we're in this situation now, and I'm going to ask both of you to take kind of the seat of a chief compliance officer, where we've seen, or it seems we're seeing, a more strategic CFPB, one that is looking more at rulemaking, policy creation. They're thinking big picture. Now, if you're a chief compliance officer, you're coming off a year where high interest rate environment, a lot of companies are having down years. There may have been some layoffs to the compliance team. There may have been some budget cuts to technology. How are you preparing your organization for these rules and policy changes, knowing that you may have less staff going into next year? You may have more people wearing multiple hats. If you were a chief compliance officer today, how are you tackling that?
It's funny. I guess if you're a chief compliance officer, that means you work for an organization that's already made a commitment to compliance, and that's good. Yeah. because there's a number that are flying out there, I think, with blinders that haven't quite made that investment. And, we see all over the place where the expectations are becoming more clear, in things like the BAS space and others for what oversight, what constitutes sufficient oversight in those things. And so there's a lot coming out, not to mention regulatory change management that happens when a new rule rolls out, and now you have new obligations that you have to address. I mean, it's funny. I've talked with companies like in the consumer lending space, like size companies that have massive differences in the number of compliance personnel. Obviously some of them may be more attuned to their obligations than the others, and some of them may have just gone through the pain of an examination or a CID, and that's let them go there. But it all drives. There's really, this is an excellent market for using automation to enhance the ability of organizations to manage all this stuff. It almost proves that if you have to just staff up completely and do everything manually, it would probably break the back of any business that's trying to operate in here. So it in the sense that it's, from a tough love standpoint, it probably compels a lot of organizations to look for tools and intelligence that helps them, in their surveillance, that helps them in their resolution and the reporting of all of these things.
So what do you think?
Yeah, so as far as actionable items, I think Gary has all the right initial advice on how to approach it. But really on the nuts and bolts, having done this the last downturn of the economy when new laws were coming in and were in flight and still in movement, it's always better to plan ahead. So take the opportunity. You're leanly staffed. Make a list of all the different things coming down the pike. There's many resources. There are law firms. There are, reg tech. There's consultants. Figure out what are the things that might impact your business and waterfall them. Risk-based approach to how you think you need to tackle and what resources you can put on each thing. There are obviously some deal breakers in some of the rules that are coming out, some real friction for certain parts of certain businesses, but they may be different for each business. So trying to plan for that beforehand does many things. It helps you plan for continuity in a new reg environment. It helps you build new products in a way that you won't break them day 5 because something's changed. And it also allows you to have the idea of what ways you can actually build with your customers around some of the things that might be challenges in the going forward. And so I think, there are some actionable things. There's a stress paralysis piece about compliance that happens particularly in financial services. And what always worked for me is really trying to make sure that you are taking the steps to have usable bites. And there are a lot of resources available to help you with each step. But at some point, whether you use tech or consultants or lawyers, you're going to have to make decisions about what is going to be most important to you and your company so your team can survive the next generation.
Yeah, I agree with that. We use a term strategic compliance, which is really being proactive and thinking about that. And I think, you've been on both sides and can talk to the out-of-pocket costs of having to respond to something after the fact. But there's also, if you're not doing that, think about it. Like, Johnny, you raised a great point. Companies are cutting staff, right? So you've got all these product rollouts that you want to build in. Now, all of a sudden, if your eye's not on the ball of what's coming down, and you have to stop what you're doing to start implementing, regulatory, make regulatory changes, that hurts your revenues. And so you really do have to be forward looking. And I think, some of the rules that are in the proposal stage right now, like, the Section 1033 open banking rule is a great example. I mean, there's just a number, whether you're a bank, an aggregator, a data using fintech, there's a number of adjustments. It doesn't change necessarily the overall business model, but the recording of consumer authorizations, if you're a data provider, and the confirming of those authorizations, or the using an industry standard methodology to check security certifications and things like that. Excuse me, sorry, I just got in the wrong light here. All of those things are new and constitute new business practices.
So yeah, it's interesting. We hear from a lot of our customers. We always joke around. There's kind of 3 times that companies come to clients come to a company like Performline for automation. Number one is they're being proactive and they're thinking about compliance. In some cases, even more before they really need to. Number two is they've hit that point where they just can't keep scaling with the amount of people they have, and they need to go to some automation. And the third one is when it's too late, when they've already received a consent order. And what we want to try to avoid is that last one. And I think you both highlighted the way to do it. It's more strategic planning up front when it comes to these different areas, being prepared for them as opposed to being caught off guard. And so, kind of using that as a good segue into some of the rulemaking. Gary, you just did a good job of highlighting some of the commentary around the open banking rules. We know this year the CFPB has been very active with things like combating junk fees in issue 29 of their supervisory highlights. There was also the proposed rule to supervise larger non-bank companies that offer services like digital wallets and payments apps. With all of these sort of new rules coming down, I'm curious, in your opinion, is there one that stands out that is going to be more of the focus of the CFPB from an enforcement standpoint? And again, any kind of best practices that you would advise clients onto how to stay ahead of some of those. Would love to just hear some of your thoughts on that. And again, Gary, if you want to start with this one, go for it.
Yeah, I mean, I think it depends on who you are. If you're Apple or Google, you're probably a little more focused on the larger participant rule. But also any of the companies like bill pay companies that could be swept into that. There's a data brokers rule, junk fees, as the White House has coined them. I think what's interesting with them are like 1033 is a great example of where the statute to do that, has existed since the Dodd-Frank was enacted and the Bureau was created. And here it is, 13 years later, and they're proposing. And I haven't met a single person who thinks it should have come out sooner. I think the overall direction of the market hadn't matured enough to do it and everything. And what's great here, yes, there will be real implementation work for the ecosystem players. But again, there's an opportunity to pave the cow paths, and look and see, okay, how is this working today? What's important? What creates consumer harm? And how do we do that? In other instances with some of these rules, an overdraft and NSF fees and things like that, look, that's been talked about for decades. I'd argue that since the creation of the Bureau, and maybe since the FFIEC started forcing large banks to start reporting NSF OD fees in a more transparent manner so that everybody could see what they're actually collecting. Banks have increased and fintechs have emerged to offer kind of fee-free alternatives to banking. We've seen some decline, maybe not in the overall levels, but companies adopting no fee policies. So those things have been happening, and they are not catching anyone by surprise. I apologize for the sunlight here. The interesting ones like the LP rule and the data brokers rule that might sweep in companies that might not have been the primary targets of those rules could create fundamental changes for those types of organizations. So an example in the data brokers side are companies, that might be doing fraud screening and fraud monitoring, who, I think it's highly justified for the Bureau to wonder aloud, maybe in hand with the prudential regulators, whether consumers are denied access to financial services products because of fraud and don't have the same recourse they do if it's because of credit or something. But at the same time, there's a safety and soundness mission there. And there would be implications if we started giving, fraudsters that are stealing identities, adverse action notices intended for the original consumer, right? So there are that would create some business model changes that probably weren't as much on the spectrum for some of those entities as those other types of rules. And then there could be a more fundamental review of the business model.
Melissa?
Yeah, so I'm gonna pull up and be more a little bit 10,000 foot on it, because to me, all of the rules that are coming out now, hand in hand with some of the supervisory and enforcement actions that have come out recently, really is just along the lines of a larger strategy that data in and of itself and payments are really clear focuses of the CFPB. And the fact that payments and data flow together, that data is a consumer protection concern, is really something that we're seeing all across. So we hadn't really mentioned the Fair Credit Reporting Act yet. All of the things that are happening out of the Bureau now is an attempt to really regulate the flow of both funds and consumer information. And there's going to be some issues for all the players in the space related to how that plays out, because funds and data don't actually function the same way. Right. And so some of the things, just picking some of the soft points or things that are TBD in these rules and how they will play out. In 1033, there's a lot about the collection, the limited collection of data for only what is reasonably necessary for a product or service, limited holds, but data does more than that in this economy. And a lot of companies rely on data for different things like marketing or improvement of products and user experience. So how is that going to work? It's unclear. And while the actual data has to flow, and that's part of the rule, who's liable for what, even if the obligations are actually laid out, someone's supposed to take the express informed consent, which is a new level of requirement that I think is going to be a real level of friction for most. But who's liable for that not happening is still unclear, TBD, right? And then the LP rule, while it's not really an enforcement piece in the Office of Enforcement traditional sense, it's an expansion of the examination authority. It's the first time the CFPB came out and said that crypto digital assets could be underneath its jurisdiction. That's really important, because that is, sort of a nod to the fact that now we can have enforcement actions that are on crypto products that are consumer financial products. And so what you see is all of this is like a full court press on expanding the Bureau's jurisdiction over markets that it conceives are consumer facing, but maybe not as traditional financial services as many who've been working in this space have thought.
Yeah, I think
that'll
that's
be
a great
challenge.
point. To riff on that and maybe to go even higher level than that. When you think about it, there used to be a line that we used to use at the Bureau on a lot of press release, helping consumers take control of their financial lives. At the end of the day, consumers have assets. It's easy, and we've always thought of those assets as the dollars in their bank account or that might, they might owe. But as Melissa's pointed out, data is increasingly that too. And so transparency and control and ensuring that consumer, whether it's express written consent, the concept of a consumer authorization and directive, and ensuring that if you are accessing or touching those consumer assets, that you're doing that in line with what a consumer would expect or want. And the want comes from the authorization. The expect comes from probably the transparency there. And you're right, the world's only going to get more complicated. The types of credit services available to us are expanding and becoming more and more specialized, right? The horse is out of the barn. We're not going to go back just to having an auto loan, a mortgage and a credit card. And so that, and the way we pay, we've moved on from checking cash to card and ACH, and now a variety of other mechanisms. And it's not going to be reduced down to one or two things. So as all these models come about, I think what we've always tried to think about is, what is the spirit of existing regulation? What is it trying to ensure? And what have the lawmakers and the regulators thought in terms of what could go wrong, and apply that lens to these existing models. And if you think about it that way, you could probably anticipate the consumer risks before a regulator is knocking on your door.
Yeah, it's really interesting. I like the way that you sort of started out a little bit more in the weeds and pulled up to the higher level view. Melissa, the way you broke it down, kind of just talking about the focus being on data and payments across these different segments is really a good way to look at it. It certainly seems consistent with a lot of what we're seeing there. So now I'm going to ask you to look ahead, right? And I don't know the answer to this, but when you all were at the Bureau, if you could have, seen the writing on the wall that some of these current rules would make their way into the public domain, and maybe those are things already being worked on, looking into next year and beyond, can you give me an idea of what you think the CFPB has in stores for financial institutions or beyond in 2024?
It's a good question. Talking with our former colleagues that are still there, I think everybody there is quite busy, so don't expect nothing. There's obviously a lot of balls in the air right now. All the rules we discussed, and none of them have been finalized. There were data collections started like on BNPL that really the shoe hasn't dropped on that. There's always been a constant rumor of something coming out back on overdraft. We talked a little bit about that in NSF earlier. And I will say, by the way, Melissa and I are both payment data geeks. Mm-hmm. We probably both spent some time in mortgage, but less attuned, or at least I am, to that and some of the other collateralized lending markets, if we tend to show a bias on those types of things. I mean, to me, what I really would like to see, if we can sit on Santa's lap, is I'd like to see something to help the market get to, with just enough tough love, but not for the sake of being tough, a clean way to enable the BaaS model. Because I firmly believe that, look, if banking has become, it is a balance sheet driven business. And back in the day when I was a former consultant and banker, a lot of projects had to do with branch location. It was a geographic business. That's no longer really the case unless you're in ag lending and certain other commercial businesses. It tends not to be. I mean, even credit union charters are like broad. They're not generally geographic, or many are, but in any event, so that means now you've got to serve and compete with everybody in the marketplace. And how do you do that? You're going to do that by being specialized, going after very defined target segments, use cases on the small and larger business side, industry verticals. And that requires specialization that I think many banks haven't traditionally invested in. And where many fintechs emerge and saying, hey, we see this slice of the pie, we can help do it. And so it's really, I think, I'm a big believer in the BaaS model. I think the fintechs get the benefit of oversight and structure, not to mention insured deposits, from bank relationships. And the banks, if they aren't able to use these fintechs, third parties, as product development, R&D, distribution centers, I think we'd see a massive amount of bank consolidation. So when I look forward, there's a lot of hemming and hawing about how this works. And I think we'd all agree that we haven't reached a mature state where every bank understands its obligation for its underlying fintechs, and every fintech is aware of what their expectations should be. So I'd love to see more focus on setting that so that the model will work for everybody. Having said that, I think we'll probably see more punitive regulations.
Yeah, so Gary's always the more positive. I'm a lawyer.
As you say, that's the non-attorney in him.
That's the non-attorney in him. I agree. I think there's going to be a lot more activity from every sector in the CFPB. They're very, very busy. Everybody's working hard. More enforcement, probably with the increase of staff, you'll see more investigations. You'll see more of them move to the end game, whether it's litigation or consent order, and some big, there are probably going to be some big announcements in 24. I think that's not going to be a surprise to anyone. The rules are going to move forward. 1033 should close, I think, next year. FCRA will probably get a notice of proposed rulemaking in the next year. There'll be some, I think there is a lien on overdraft. Probably something comes out. There's a big push, I think, at the CFPB to lock in the gains of some of the work that's been done over the last year, and I think last couple of years, and I think you'll see that in either advisory opinions or more of the rulemaking. And supervision is going to continue to actually note the dollars and cents it gets back in their exams, and we're seeing that examiners are asking for more and more money back from exam subjects. And so, I think that's going to happen as well.
Yeah, I do think, believe it or not, there is a fixed capacity to what the Bureau can churn out. I mean, Melissa touched on this a little bit on the enforcement side. Rulemaking is done correctly, and not to suggest that the Bureau is not doing it correctly, is a heavy lift. I mean, there's you need data-driven evidence to do it right. There's these public comment periods that we're going through, and it really has to be thought out. And then on top of all of that, as we continue to see, there's going to be legal, threats and pushback on some of these things if they feel like the authorities, weren't implemented effectively to carry out those rules. So there will be a lot coming out, but you could easily get to a point where parts of the Bureau are kind of consumed also. So I'd advise everybody to pay attention to the regulatory agenda. I think the fall one hasn't come out yet, but it generally comes out, I thought, around the end of November. Some of that may just be a confirmation on what we've already heard, but it can be an early indicator of things. The first administration would indicate things on the pre-rule status and stuff that's in the pipeline. And so it's just look for the interagency regulatory agendas and look up the CFPB, and in a few days, we should probably get some more insights.
Yeah, it sounds like, just in the last 5 minutes, you all gave a lot of good things for the listeners to think about when it comes to planning for next year and the CFPB's potential agenda. Now is the time to start thinking about, your regulatory change management practices. And like we talked about, whether it's having to hire additional staff or make that proposal, or adding technology that allows you to automate in certain areas and do more with less. It does seem like next year is going to be another year where a lot of these things are going to be top of mind and need to be actioned on by companies. I guess the last question I'll ask you, and it's sort of in the same vein, heading into an election year, Gary, you had mentioned earlier that the CFPB in its 12-year history pretty much had two resets, right? In 2016 and 2020, when we flipped administrations. Looking into 2024, if there is an administration shift, do we think there will be another sort of reset? Because that's just kind of natural bringing in people. And if not, if it remains the same administration, do we think that will allow the CFPB to continue some of the momentum they've created over the last 2 years and build on some of these rules and programs.
Well, let's remember that even before that, the Supreme Court could rule against the constitutionality of the Bureau, although by the hearing they had earlier this fall, it didn't sound like they would create the chaos that could be in the market by unwinding everything that's been done. But we should hold that out there. I mean, I'm glad you asked this question, John, because I was just thinking that, if there is an administration change, I think, yes, the threat of examination or the depth of it or the threat of enforcement actions may subside. But, again, we talked about this. The point of all these regulatory obligations is to ensure that, at least in the CFPB, consumers are treated fairly. And if I go back to what I said before, if you embrace the spirit of what's trying to be done there, I wouldn't take my foot off the gas of any of those things. You might not have to staff up for exams quite as soon or as frequently as you thought, but if you're harming your consumers, you're probably harming your own business outlook. If the Democrats win again, I still expect at some point that Director Chopra would move on. I mean, they're on a 5-year term maximum anyhow, and so we've seen both Melissa and I worked with Rohit, in the first iteration of the Bureau. And the way that the Bureau is being administered now is different than it was under Rich. Their people have different styles. And you're also at a point where in some ways it was easier in the beginning. It was harder because new kid on the block. Let's be careful about we're contentiously created. Let's be careful about how we do that. But there were a lot of statutory obligations. Now rulemaking is becoming, after 1033 and 1071, more discretionary, if you will. And so that just increases the likelihood that whoever the leadership is going to come in with different focus than the one before it. It could be less on payments and more on mortgage, especially depending upon how interest rates move and housing, policies change. So all those types of things could change the flavor.
So what I will say is I'm going to put in a plug for career staff and the fact that after 12 years, there are people who are still there from day one. And so, what happens up top will always change the decor and maybe some of the direction, but the work that's there, the stuff that's in the pipeline, the sunken costs of what already has been done is going to maintain no matter who's up top after 24. And so it does not behoove anyone to take their foot off the gas, as Gary said, because the extensions of all the powers I talked about in enforcement, the broader jurisdiction will all be there. And I don't know about you, Gary, but what I thought was interesting about serving all the different directors is once in that seat, no matter who it is, the tools become a little bit more fun to use. Regardless of how you might not use them to the same degree, but they're still there. And I think there is that piece of it that maintains no matter what. So you might have like a reprieve or what seems like a reprieve, but all of that stays for the next time. And it is not going to do you well to sort of decide that you don't have to do anything and then wait till the tide turns again.
Yeah, I agree. And it does seem now, and we mentioned this a little bit in our pre-call, just the state of the economy as a whole. Gary, when I think back to what you said, the Bureau was founded on helping consumers take control of their financial lives. Well, consumers are heading into another year of uncertainty, high interest rates, increasing debt. And so the idea that, this organization is here to help those consumers, it feels like will be an important thing to maintain some balance in no matter how the election goes. And In addition to that, just look at the complaint volume number. It does seem like more consumers are now aware of the CFPB and what they're here to do, probably in a way that they weren't in 2016 when we saw, kind of the first shift in administration. So,
way to bring it back, John.
Yeah, thank you. I appreciate that. Well, with all that, we made it through just about an hour. We covered a lot of ground. You all were fantastic. We really appreciate the time and the insights, and to help our audience kind of prepare for what may be another challenging year for the compliance and legal side of the business. This will certainly be a great resource for them. Just so they know, how can they get in touch with you if anyone has any follow-up questions?
We both have very robust websites, I'm sure. I'm at oric.com, Melissa Alguidarizi. All my contact information is right there. And I'm also on LinkedIn.
Yep. 99 FinTech, with the word spelled out, fintech.com. G Stein at 99 FinTech, also on LinkedIn. And yeah. And if you can't find us, call John, and John will forward to us.
Definitely. And if you need anything from PerformLine, call me anyway, and I'll make sure that you get that. But Gary and Melissa, thanks for your time. Have a great holiday season. We look forward to seeing you again soon.
Thank you. Thanks for having us.
Thank you.